Federal Reserve Chairman Jay Powell will say in a speech here at Jackson Hole that gradual rate hikes remain appropriate, and there does not seem to be a serious risk of overheating in the economy. Powell says this despite going on to say the U.S. economy has strengthened substantially. Most people who want jobs can find them, and that he expects strong economic performance to continue. If that does happen, in other words, if the forecast of the Federal Reserve at this point comes to fruition, in that instance, he says gradual increases in the funds rate will be appropriate. He says the Fed will do whatever it takes, in quotes, if inflation expectations become unanchored. That is, either go up or go down and come off of this general 2% inflation expectation that's out there. But he goes on to say there is no clear sign that inflation is accelerating above the Fed's 2% target. He does see some risks out there to the economy. Let me go over what those are. He says real wages have grown slowly, the economic mobility has declined, and that the federal deficit's on an unsustainable path, and he points out low productivity. He does, however, say that it doesn't look like monetary policy can do much about any of these issues that are out there, that he sees are the main risks to the economy. In this speech, Powell essentially ponders what the Fed should do with a history of getting certain critical things wrong, like the natural unemployment rate, like the natural interest rate. And he goes through the history of how the Fed has had these things wrong and found in hindsight. So what does the Fed do in that situation, particularly in an environment right now where people say, wait, there's no inflation, why are you raising rates? And look how low the funds rate is, why aren't you raising them why aren't you raising them faster? And he says the best thing to do in that situation is to move slowly and gradually. And he says that uncertainty endorses the Fed's policy right now of raising rates gradually. Sarah.
Steve, just parsing through all the headlines, it sounds like it's a lot of topics and headlines that the market cares about: inflation, the economic growth, policy normalization, but not much in terms of the change in expectations for 2 more interest rate hikes this year.
No, Powell's got his ideas of how policy should go. He has his forecast for the economy. That hasn't changed much. And by the way, as you've heard from several of our FOMC guests, they're not changing either. Despite the stronger growth, there's an expectation of a decline in growth. There might be a difference between Powell and some Fed members about the expectations in 2019 and 2020. I think it's important that Powell says he expects strong growth to continue. I will note he doesn't put a time frame on that or a number on that, but he does think strong growth will continue, but he doesn't change his outlook for the funds rate. So to me, Sarah, this says September's on, December's very likely, and then there's that question about what happens next year and where the neutral rate is. What we're hearing from our guests, Sarah, is that 2.5% to 3% is the neutral rate many officials are looking for, and that means the Fed has some work to do after December, but not a whole lot.
Steve, the idea that Powell is putting out there that he does expect strong growth to continue without really imminent risks of overheating, without inflation running away from him, it's not exactly as if he's saying that we can kind of pencil in Goldilocks forever. But it does remind us, I think, a little bit of Greenspan in the 90s, where he said, look, by the old rules, we should have a lot more inflation than we do. There's some kind of productivity revolution going on, not really happening here. But something about the economy has changed. It's at least forcing us to have some humility and flexibility with how we go about setting interest rates.
So the problem, Mike, is that most people don't know how ridiculously smart that you are, Michael. Because, in fact, in the speech, he goes through the mid-90s experience of Alan Greenspan, and he details exactly what you just said, which to me is the bestest thing that Greenspan ever did, which is to look inflation in the eye in 1996, see that something has changed in the economy, and decide not to raise interest rates despite the conventional wisdom. He mentions that example directly as a potential error for the Federal Reserve, and I think that is extremely instructive for understanding that Powell does not want to make the mistake. And let me just go a bit further, which is there's a certain sense to this speech which says why it may be a good idea to have a non-economist as the Fed chairman, because he takes a step back, he goes to this 30,000-foot view, and he goes through the errors of the Federal Reserve over the course of, say, the past 30 years or even back to the 1960s with a dispassion of a guy who doesn't have a dog in the hunt or a horse in the race, in the sense that I don't adhere to any of this ideology out there, but look at this, and my commitment now is to not to repeat the errors of the hubris of the economic community at the time when it thought it knew things and it turned out it didn't know them so well.
Steve, the use of the whatever it takes when it comes to inflation, I don't know, immediately put me in mind, of course, of Mario Draghi a little more than 5 years ago when he talked about maintaining the euro. Is there any read into that at all, or is he using that language all the time?
So, again, David, that's a great point to make. He uses that language, and that language is pregnant with echoes of the, sorry to mix the metaphor there, pregnant with the echoes of the financial crisis, in the sense that whatever it takes was the language that Draghi used in the crisis, very similar to language that Bernanke used in the crisis, but now he's using it differently. He's using it in a symmetrical way, and he says whatever it takes if inflation expectations become unanchored to the downside or to the upside. It's not a whatever it takes in terms of saying I'm concerned about a crisis and I'm going to do whatever it takes. He says this is what will happen if we get inflation expectations unanchored either way.
Steve, just want to tell you about the market reaction that we're seeing. A little bit of weakness here for the dollar index. It was weak already today. It's now down to session lows. Treasury yields come a little bit off the highs. They go below 2.84%, still elevated. I guess the pairing of gradual hikes are appropriate and not a really elevated risk of overheating signal. We're not going to get ahead of ourselves. We're not going to hike interest rates more than the market thinks, and therefore maybe slightly dovish tilt. Do you agree?
I think that's the right takeaway, and I think this notion that he doesn't see the risk of overheating, he's doubling down on the strategy of the Federal Reserve at the moment, which is to move gradually, and despite the strong growth. Look, Sarah, I believe the great challenge for Powell, as every chair and chairman has faced a great challenge, the Greenspan challenge in '96, or say even the bursting of the tech bubble. Powell's great challenge is going to be how to incorporate this wave of fiscal stimulus into his outlook for monetary policy. At the moment, he's not blinking, and my guess is what he's deciding to do here is if he has an inflation problem, that's where the question that Faber asked about is, that's where whatever it takes comes in. If we become unanchored, if the fiscal stimulus pushes us above a place where we're concerned about, that's when we'll do things. But right now, I think you're right, Sarah. There's a dovish tilt to this in that he's doubling down on his policy outlook, despite saying that we have strong growth now and he sees strong growth continuing.